Saving money is a great start, but if your money just sits there forever, it may not help you build real wealth. In this video, we'll walk step by step from simple saving to confident investing. No hype, no complicated jargon, just a clear path you can actually follow. Before we begin, remember, this is education, not personal financial advice. The goal is to understand the process so you can make smarter choices for your own situation. Let's start with the first question. Why save at all? Saving gives you stability. It protects you from surprises, a broken phone, a car repair, a sudden bill. Savings help you avoid panic. But saving alone has a hidden problem. Over time, prices usually rise. That means cash can slowly lose purchasing power. $10 today may not buy the same things 10 years from now. That's where investing enters the story. Investing means putting your money to work in assets that may grow over time. Stocks, bonds, funds, real estate, and other assets can all be part of investing. But investing is not a magic button. It takes planning, patience, and a clear understanding of risk. Step 1. Build your financial foundation. Before you invest, know what comes in and what goes out. This is not about judging yourself. It's about getting clarity. You cannot invest consistently if your money disappears every month without a plan. Start by listing your fixed expenses. Then list your variable expenses: food, transport, entertainment, and everything else. Once you see the full picture, you can decide what to keep, reduce, or remove. Small cuts can create your first investing dollars. Step 2. Create an emergency fund. This is money you do not invest. It stays safe and accessible. For many people, a good target is 3 to 6 months of essential expenses. If that feels too big, start smaller. Your first goal could be $500 or $1,000 or any amount that gives you breathing room. The point is to avoid selling investments during a bad moment just to pay an emergency bill. Step 3. Handle high-interest debt. If a credit card charges 20% interest, that is a powerful force working against you. Paying that down can be one of the best returns you will ever get. That does not mean every debt must disappear before you invest, but expensive debt deserves serious attention. Step 4. Define your investing goals. Investing without a goal is like driving without a destination. Ask yourself, what am I investing for? A short-term goal might be money needed in 2 or 3 years. A long-term goal might be retirement, financial independence, or building wealth over decades. The time frame matters because it changes how much risk may make sense. Money you need soon should usually stay safer. Money you do not need for many years may have more time to ride the ups and downs. Step 5. Understand risk. Risk is not just losing money, it is uncertainty. Investments can go up, down, sideways, and sometimes test your patience. The key is not to avoid all risk. It is to choose risk you can understand and survive. If a market drop would make you sell everything, your plan may be too aggressive. A good plan should let you sleep at night. Step 6. Learn the basic asset types. Cash is stable and useful for emergencies, but it usually has limited growth. Bonds are like lending money to governments or companies in exchange for interest. Stocks mean owning a small piece of a company. When companies grow, stock investors may benefit, but stock prices can be volatile. Funds can hold many investments inside one simple package. That can help beginners diversify more easily. Step 7. Understand diversification. Diversification means not putting all your eggs in one basket. If one investment struggles, others may help balance the ride. It does not remove risk completely, but it can reduce the damage from one bad choice. For many beginners, broad index funds are a simple way to diversify. An index fund tries to track a market index instead of picking just one company. Think of it as buying a slice of a large part of the market. Step 8. Learn about compound growth. Compounding happens when your gains start generating their own gains. At first, it may look slow, but over long periods, compounding can become surprisingly powerful. Time is one of the most important ingredients. The earlier you start, the more time your money has to work. Even small amounts can matter when repeated consistently. Step 9. Choose your investing account. The right account depends on your country, your goals, and your tax situation. Some accounts are better for retirement, others are more flexible. Do a little research before opening anything. Look at fees, tax rules, investment choices, and withdrawal conditions. Step 10. Understand fees. Fees may look small, but over time they can quietly eat into your returns. A difference between 0.1% and 1% can become meaningful over decades. So compare expense ratios, trading costs, and platform fees. Lower fees are not everything, but they are one thing you can control. Step 11. Decide your asset allocation. Asset allocation means how you divide your money between different investment types. A more growth-focused plan may hold more stocks. A more conservative plan may hold more bonds and cash. There is no perfect allocation for everyone. The best allocation is one you understand, can stick with, and can adjust as life changes. Step 12. Build your first investing plan. Keep it simple enough that you can explain it in 1 minute. For example, I will invest a fixed amount every month into a diversified fund for a long-term goal. Simple does not mean weak. Simple can be powerful. Step 13. Start small. You do not need to wait until you feel rich to begin. Starting with a small amount helps you learn how investing feels. It turns theory into experience. Your first investment does not have to be perfect. What matters is that it fits your plan and your risk level. Step 14. Automate your contributions. Automation removes the need to decide every single month. When investing becomes a habit, consistency gets easier. Think of it like paying your future self first. Step 15. Use dollar-cost averaging. That means investing a fixed amount regularly, no matter what the market is doing. Sometimes prices are high, sometimes they are low. With regular investing, you avoid trying to guess the perfect moment. Market timing sounds smart, but it is extremely difficult. Consistency is often more useful than prediction. Step 16. Expect market drops. Drops are not rare accidents, they are part of investing. A long-term investor should not be shocked when the line goes down. Your plan should already include what you will do during a downturn. If your goals have not changed, a market drop may not require action. Sometimes doing nothing is a disciplined decision. Step 17. Avoid emotional investing. Fear can push you to sell low. Greed can push you to buy something you do not understand. A written plan protects you from both. Step 18. Watch out for hype. If someone promises fast, easy, guaranteed returns, slow down. Real investing involves uncertainty. That is normal. If you do not understand how an investment works, you are not ready to put money into it. Step 19. Keep learning. You do not need to become a Wall Street expert, but you should understand what you own and why you own it. Read fund descriptions, learn basic terms, ask better questions. The more you understand, the less scary investing becomes. Step 20. Review your plan, but not every 5 minutes. Checking too often can make normal movement feel like a crisis. A monthly, quarterly, or yearly review may be enough for many long-term investors. During a review, check your goals, contributions, allocation, and fees. Do not confuse review with panic. Step 21. Rebalance when needed. Over time, some investments grow faster than others. That can move your portfolio away from your original plan. Rebalancing means bringing it back to the mix you chose. It is a way to stay disciplined instead of chasing what just performed best. Step 22. Increase contributions when your income grows. Raises, bonuses, and side income can speed up your progress. You do not have to invest every extra dollar, but giving your future a share of each increase is a powerful habit. Step 23. Protect yourself from lifestyle creep. Lifestyle creep happens when every raise turns into more spending. It is not wrong to enjoy your money. Just make sure your spending and investing both match your values. Step 24. Measure progress the right way. Do not judge yourself only by today's market value. Track what you can control, how much you save, how much you invest, and whether you follow your plan. Markets will move. Your habits are the foundation. Step 25. Think in years, not days. Wealth building is usually slow at first. Then, as contributions and compounding build, the results can become more visible. The boring path can be surprisingly effective. Save first. Build safety. Learn the basics. Invest consistently. That path may not sound exciting, but it is clear and repeatable. Let's quickly recap the journey. First, understand your cash flow. Then, build an emergency fund. Next, manage expensive debt and define your goals. Learn risk, diversification, fees, and asset allocation. Then, start small, automate, stay consistent, and keep learning. Turning saving into investing is not one giant leap. It is a series of small, smart steps. If this helped you, subscribe for more simple money lessons. And remember, the best time to build your future is one step at a time.